Good evening everyone. Welcome to ixamBee. Continuing with our series of discussing important documents by the government and by the RBI and other regulators. Today we are going to discuss the RBI Monetary Policy for February 2021, which has come out today morning. So the monetary policy has remained unchanged. The repo rate remains at 4%. And the RBI is continuing with the accommodative stance. So in today's session, we will look at what are the key policy parameters, what is meant by MPC, and then discuss the various regulatory and development guidelines and norms that RBI has announced. So in every monetary policy, apart from the policy rate, the RBI also tells about the various steps it's taking to maintain stability in the financial system. Right? So we'll discuss those, and as always, we will also discuss some important MCQs today. Right? Talking about this RBI week, we have discussed the financial stability report, the budget, the economic survey. Today we are discussing the RBI monetary policy, and tomorrow again we'll be discussing the RBI annual report. So if you have missed any of the sessions, you can see the recordings on the YouTube channel and also get the PDF for all these sessions in the respective description box. So tomorrow again, please stay tuned to at 4 p.m. Okay, so talking about the current monetary policy, the policy rates have continued to be the same, unchanged. This is the fourth time that the policy rates have remained unchanged. Okay, so what are the rates? It's important to remember. So we will look at this column. February, this was the last December, then also the rates were same, and there has not been any change even in the current monetary policy. So the repo rate remains at 4%, reverse repo remains at 3.35%, and the MSF and also the bank rate, both of them are at 4.25%. Some important points I keep highlighting every time. Please remember, this is the policy rate, and the reverse repo and MSF are the other windows. The difference between the reverse repo and the bank rate gives you the policy corridor, okay, which as of now is 90 bips. Right? So that is there, and as I said, this is the fourth time the status quo has been maintained. The last time the repo rate was changed was in the May 2020 MPC, at which time, you know, by the repo rate was cut by, and all the other policy rates were cut by 40 basis point. So just a trivia that you can remember. So this was during the COVID times, when a sharp decline was or cut was being done in the policy rates, and since after that we have been maintaining the repo rate at 4%. Similarly, the accommodative stance has also been going on for a long time, and the RBI has said that it was going to continue with the accommodative stand in the current financial year and also in the next financial year. So the current financial year is FY21, right, which is going to end in the next month, and next financial year also, that is FY22, is when the RBI is going to maintain most likely the accommodative stance so as to support the economy, to help in the revival of growth on a sustainable and durable basis, and to mitigate the impact of the COVID-19 which has had on the economy. So they will continue with the accommodative stance. So as I keep suggesting, whenever we are reading certain reports, we are reading the news, we should always also think about the conceptual part. We should know about the background of things, because they become important, and good GA questions, and also some now will help you in writing descriptive answers. As you all know, in RBI Grade B this year, in the phase 2, descriptive parts have been added for all the FM and the ESI paper also. So having a little understanding and background about things that you read about is always good. So here I'm giving a brief of the MPC. MPC is what? The Monetary Policy Committee of the RBI. Okay. So this committee has constituted by the government, and it is constituted under section 45ZB of RBI Act 1934. Okay, this type of questions have been asked in the GA section in the past for few regulatory body exams. So knowing these information is good. Then the MPC consists of 6 members. 3 of them are internal from RBI and 3 are external members. So who are these members? The 3 internal members the 3 internal members are the RBI governor, the deputy governor of RBI who is in charge of the monetary policy, and one more officer of RBI who is nominated and elected by the central board of RBI. So these are the 3 people who are the internal people who own the MPC, right? And the RBI governor is, by default ex officio the chairman of the MPC committee. Okay, so as of now, who are they? Mr. Shaktikant Das, he is the governor and also the chairman of the MPC Monetary Policy Committee. The other members, the internal, are Dr. Michael Dipatra, he is the deputy governor. You can write in the comments box how many deputy governors are there in RBI and maybe who all are they, right? The other internal member is Dr. Mridul Kesagar. He is an executive director at RBI, and the 3 external members as of now are Dr. Ashima Goyal, Dr. Jayant R. Verma, and Dr. Shashikant Bhinde. The external members are appointed by the central government, and these people are, the people of ability and knowledge and expertise in their fields, which are related to economics, banking, finance, and monetary policy. So, from these areas, they are picked up and they are appointed by the central government for MPC. Okay. Again, you can write in the comments box for how long, what is the duration of appointment for the external members of MPC, right? So MPC, the Monetary Policy Committee, it meets 6 times in a year on a bi-monthly basis. Okay, so the last monetary policy was in December, now it has come out in Feb. So every 2 months the monetary policy meets, and what are they basically focusing at? We follow the flexible inflation targeting framework. Okay, it's abbreviated as FITF, flexible inflation targeting framework, where the target set by RBI and the central government, they have agreed on for 5 years, is 4% with an upper and lower tolerance of 2%. So basically on an upper side we can go up to 6% and the lower side 2%, right? So 4% is targeted. Okay, so this is not minus, this is arrow. 4% is targeted with a tolerance level of 2% on the downside and 6% on the upside. So this inflation target is set in consultation with the government and RBI, and they are set for 5 years. Okay, so these 5 years are due to expire at March 2021. The RBI has kind of indicated that they will continue with the same target going forward also, but in a written and a formal statement is yet to come out in that regard. But they have indicated that this is kind of apt to follow. Okay, another aspect in the monetary policy is, first the current state of the economy is discussed, and then RBI also gives its own outlook, especially in relation to 2 aspects. One is the inflation outlook and the other is growth. Okay, inflation, as I told you, inflation targeting, flexible inflation targeting is the approach for the MPC. So of course they have the inflation, but it also has an implied impact on the growth. So looking at growth is also important. So these are the 2 outlooks after assessing the economy and the status of the economy, both global and domestic. RBI comes out with its outlook. Okay, so for this year, yes, so that is I'll just see the comments. Yes, this is correct. that the members, external members, are appointed for 4 years, and yes, Mr. Patra, Mr. Rajeshwar Rao, and BP Kanungo are the other 3 deputy members as of now. That is correct. So inflation, for inflation, first the current status is that the inflation has come in the manageable limits, the target limits of RBI as of December, and going forward RBI feels that it will be maintained at similar levels. Why? Because the food inflation has started to ease, and the major risk that comes is from the petrol prices, which can have an impact on the inflation, but otherwise the food inflation, which was initially hampering the economy, has started to ease as the supply chains in the country have opened up after the unlocking, right? So for the 4th quarter, that is the last quarter which we have already through with, halfway we are through. January is ended, we are sitting in Feb, and March is when we end the 4th quarter. So the 4th quarter, the currently which is going on, the estimation for inflation has been given at 5.2%. For exam purpose, you don't need to remember the inflation targets and projections per se by RBI, and definitely not for the different quarters. Overall you can have a view. So they are saying in the range of 5%, so that is enough for you to remember. For next year also they are saying that it will remain in the similar range and then have a declining bias. So in the first half they expect it to be in the range of 5 to 5.2% and then decline to 4.3% in the 3rd quarter of next financial year. As I said, you don't really need to remember the inflation projections per se. Growth numbers projection overall, which RBI says you can keep in mind. Rural demand, so first the outlook, how the growth is going to be supported. So both on the rural and the urban demand is going to support the growth in the economy. Rural demand has been helping till now, and it will continue to help because the agriculture is doing good. So if you will remember from the session that we did yesterday on economic survey, agriculture was the only sector that is expected to give a positive growth in the current financial year at the rate of, anybody remembers the rate that has been mentioned? The growth that was mentioned in the economic survey was 3.4%, while industry and services sector are estimated to decline in FY21. So the good prospects of agriculture will support the rural demand in the economy, right? So I am trying to bring those points so that you are able to correlate things, right? As I've been saying the entire week this time, all of these reports, various publications, they are more or less in sync, and they because they are ultimately talking about the same economy, right? So we should try to correlate things. It will help us to have a clearer picture and also remember some of the statistics. And the urban demand, the policy has gone on to further say that the urban demand is now picking up. How it is picking up? Because of the unlocking, people are coming back to a normalcy in life. There is a decline in the COVID spread, and now with the vaccination rollout, things should come out to normalcy even more now. So demand from the urban sector, from the urban side, is also expected to now add to the growth and the economy. And the economic survey has talked about a V-shaped recovery. Okay. The other factors, so as I said, everything is correlated. So the RBI has also brought in what Union Budget has put a thrust on, that the health and well-being. So you will remember that the budget is built on 6 pillars. They had talked about 6 pillars. Here only 3 have been talked about: health and well-being, infrastructure, innovation, and research. So these will also help to give impetus to growth in the economy, right? And then they have given their projection for next year, which they have projected at the growth of 10.5%. Again, in the comments box, please mention what are the growth projections being given for the next year FY22 by the government and by the IMF. Okay, so if you all can reply, what has been the growth projections being given by the government and by the IMF for 2022. RBI has given 10.5%, and that also they have divided into two aspects. The first half they are saying can grow anywhere between 26.2% to 8.3%. Basically, they are saying 26. They expect 26 the higher growth in the first quarter, because the first quarter in 2020 was the worst hit, so growth there, and then the second quarter, and then in the third quarter growth of 6% year on year is expected. So Ashutosh, no, not 11.7. Nilesh, yes, you are correct. The government has estimated a real GDP growth of 11% in the budget. They have mentioned in the economic survey, both they have mentioned 11% real GDP growth is expected next year by the government, and the IMF, they also give their update every 2 months. So as of the latest update in January, they have said 11.5%. So this is how you can remember. There's a 0.5% difference between the three organizations, entities. 10.5 by RBI, then the government at 11% and IMF at 11.5%. This is how you can remember. Okay, you don't need to remember these for the exam. This is enough. These two are other important numbers that you should remember. Okay, now moving to the development and regulatory policies that RBI comes out with in its every monetary policy review. Okay, so in the area of liquidity measures, that is, RBI shows there's liquidity, enough liquidity. We have been in surplus liquidity, in fact. So the liquidity is enough in the system, right? So to maintain that, there was a scheme of TLTRO that was announced I think somewhere in October, and they had announced a TLTRO scheme, and now what they have done is they have extended this to the NBFCs. Okay, so it's not like NBFCs can directly avail money under TLTRO from the RBI. No, because that the repo transactions happen between the banks and the RBI, not the NBFC sector. But how they will be included is that the banks can lend to NBFCs, who can further lend for the purpose of for which TLTRO was made. So again, you can write in the comments box why TLTRO was brought in. Okay. The next measure that have been taken is in relation to CRR. What is CRR? CRR is your cash reserve ratio. Okay, so banks are supposed to keep a certain percentage of their NDTL. NDTL stands for net deposits and time liabilities. So in a crude manner, if I say, the money that the bank gets from its customers in the form of various kinds of deposits, say savings deposits or current account deposits or time or fixed deposits. So all that money that our banks get net of certain things, they are called NDTL, net deposits and time liabilities. A certain percentage of that the banks are supposed to keep in the cash form with the RBI. Okay, so as to have liquidity available with them. So this CRR ratio was originally 4%. It was brought down to 3% last year in March 2020, when the lockdown started, when the COVID had hit the globe and in the Indian market. So to provide enough liquidity, RBI had cut down the CRR, but on a temporary basis. They had said that we are cutting the CRR by 1% for 1 year. Okay, so that 1 year is going to expire on 26th March, right? So RBI has now said that we will come back and restore the 4% in a phased manner. So they are doing it in two levels. Banks have to bring it up to 3.5% from March onwards, and they have to bring it up to 4% from May. So they are giving another 3 months. oh sorry, 2 months, to bring it up to 4%. Okay, so again, when we were discussing another point, I'm correlating. Yesterday, when we were discussing the economic survey, there was one point that has been mentioned about the regulatory forbearance. Anybody remembers what that point was about regulatory forbearance? Okay, so the point that was made by in the economic survey about regulatory forbearance was that is an important, it was important to give certain relaxations to save the economy in the crisis, in times of crisis that time. However, the regulators should know when to and how to withdraw those relaxations, because relaxation should not become the norm. Okay, so maintaining asset quality is very, very important in the financial sector, and therefore the regulator should take care. So you can say this is one of the, one of the relaxations that were given, and RBI is taking care of what all relaxations were given and how many of them needs extension and which ones need to be brought back to their original level. So this is, CRR is one of them which are going to be brought back to its original level over the next 4 months. Okay, beginning March and then May. The third point is about the MSF, the marginal standing facility. This was another relaxation was given. So CRR relaxation is being rolled back in a phased manner. MSF relaxation has been extended. What was done here was that the MSF, availing funds are using the MSF window by dipping into the SLR. So there are SLR statutory liquidity requirements, which certain investments that fall under the SLR, which are basically your G-Secs and gold and cash. So investments made in these, against this the banks can borrow under the MSF window, marginal standing facility window, to the extent of 2% of their NDTL. However, during COVID times, this limit was increased to 3%. Okay, so here the banks had their own money which they could use, so that limit had been reduced so that to give liquidity. Here they can borrow, therefore the borrowing limit was increased to help the liquidity. It was increased from 2% to 3%. So if you understand what is MSF and what is CRR, you will know which one was reduced and which one was extended. Conceptually you will understand and you will be able to remember, just in case you forget that time. Okay, so as I said, it was increased to 3%. Okay, and now this has been extended up till September 30, 2021. It is due to expire by March end 2021, but RBI has said we have given you an extension of another 6 months, which is expected to give additional liquidity of up to rupees 1.53 lakh crore if availed by the banks. So this will help them meet their liquidity requirements and also the LCR requirement. What is the full form of LCR? Please write in the comments box. Please keep participating. Ashutosh, Nilesh, you two are the only ones I can see. Divya, who are participating. I'll encourage everybody else to also keep participating, please. What is the full form of LCR? Because this relaxation of MSF will help them to meet the regulatory requirement with respect to LCR. In fact, this full form I think was asked in the SEBI exam very recently this year. Moving ahead, in areas of regulation and supervision, what RBI has announced, first step is relation to the SLR, statutory liquidity ratio holdings, in the HTM category. HTM is your held till maturity, which are the investments. When a bank makes investments, their investments are classified under three types of investments: the HTM, which is held to maturity, then there is AFS, available for sale, and then there is held for trading, HFT. Okay, so these are the three categories in which the investments made by a bank are classified. Okay, so the SLR holdings which are allowed to be there in the HTM category as such was 19.5% only. RBI increased this limit to 22%, and this again has been extended till March 31st 2023. Okay, initially it was there till March 2022, so one more year extension has now been given by RBI for these investments. On the side of promoting credit growth to the MSME sector and the entrepreneurs, RBI has allowed banks to that whatever new MSME borrowers they give any loan to the new MSME borrowers, that will be allowed to be deducted from their NDTL for calculation of CRR. Okay, and then they have gone ahead to tell what is the meaning of new MSME borrowers. Before that, I'd like to explain to you what this means and how is it helpful for the banks. See, as I said, the banks have to keep a certain percentage of their NDTL for CRR. Okay, so say if the bank has 100 rupees as NDTL, okay, for CRR, if the CRR is 3% as of now, that means they have to keep aside rupees 3 as cash, and they can now use rupees 97 as for lending purpose, right? Because this is your NDTL. Now the RBI is saying if the bank is giving loans to the new MSME borrowers, such loans will be allowed to be deducted from NDTL calculation, right? So say now you had NDTL, and out of this 97, the bank gives 5 rupees to a new MSME borrower. Okay, so for the purpose of CRR calculation, your NDTL actually becomes 100 minus 5. Why? This was the actual NDTL, and you have been allowed to deduct the amount that you have given to the MSME borrower by 5. So this becomes 9.95. Okay, and now you have to give only 3% of your you have to keep 3% of 95 and not 3% of 100. So basically that becomes 2.85. So now you keep 3% of this, which is 2.85. So as such, the bank gets additional 0.15 rupees to now lend. Okay, so when the numbers are huge, this makes a lot of difference. Okay, so that is the benefit the banks will get. And who are the new MSME borrowers? The new MSME borrowers are they should be an MSME, and they should not have taken any kind of loan from the entire banking system as of Jan 1st 2021. The new loan that they take should be up to rupees 25 lakh only, and this loan should be given up to from today to October 1 2021 for up to 1 year. So these are the criteria to define a new MSME borrower for the benefit of deduction from NDTL. Hope you have understood how this benefits the banks. So Ashutosh, HTM category, as I told you, held to maturity. The benefit of keeping investments in held to maturity is you don't have to market them on a daily price movement basis. So if the bank has invested in, say, some shares and they fall in the HTM category, then they don't have to change their value as per the change in the price, the market price every day. Okay, similarly, if they have invested in the government bonds GSECs, the price of GSECs are also changing, right? So they don't have to change it on their balance sheet every day. So that helps them in their not taking a hit on their profitability in case the prices go down. So that is the held to maturity category. Okay, so LCR, liquidity coverage, all of you have answered correctly. The other point related to regulation and supervision is with relation to the Basel norms implementation. So there were two things that had to be implemented under the Basel, which is pending implementation in India. One is the last tranche of CCB. Again, please write the full form of CCB in the comments box. Okay, so CCB refers to okay, there I've asked that in the comments box. So the last tranche is pending implementation. This has been extended from last 1 year. It was supposed to get implemented by 1st April 2021. It is unlikely to happen because the banks are still suffering and struggling for capital. So the RBI has further extended it by 6 months, and now the implementation date has been extended to October 1, 2021. Okay, and for the NSFR, okay, net stable funding ratio. NSFR stands for net stable funding ratio. If you do not know, then please remember this full form also. CCB is capital conservation buffer. Yes, Ashutosh, that is correct. Nilesh, no, it is not counter cyclical buffer. It is CCB is capital conservation buffer. Counter cyclical buffer is usually abbreviated as such abbreviations are not used for counter cyclical buffer, but if it is written as CCYB. Counter cyclical buffer. CCB is capital conservation buffer. The last tranche is pending for implementation. NSFR implementation has also been deferred to October 1. Anybody can tell me what is the NSFR implementation that was supposed to happen that has been deferred? Okay, moving ahead. The other points that have been mentioned, the details will follow, but RBI has said that they will be reviewing the regulatory framework for MFIs, which is what? Microfinance institutions, the institutions that lend for less than 50,000 to individuals. And they will also set up an expert committee to review the regulation and the supervision related to the UCBs, the urban cooperative banks. So urban cooperative banks have been brought under RBI's purview for regulation recently. So they were under dual regulation, but now of the state government and RBI. But for the urban cooperatives, RBI was given a heads up, upper hand for the regulation, and therefore an expert committee will be set up by RBI to have a proper review of the regulation for UCBs. So these two will be revised. The details will follow. As of now, RBI has mentioned that they will be doing this. In terms of deepening of the financial markets, RBI is now going to open up the gilt accounts for retail participation directly with RBI, right? So gilt accounts basically they stand for the government sector bonds market. So government sector bonds market, the participants usually are banks and the primary dealers. The retails were allowed participation through a window on the exchanges or through these primary dealers, but now RBI is saying they will allow retail participation directly with the RBI, and these accounts they have given a name to it also. Next, they have announced that FPIs will be allowed to invest in the defaulted bonds. So there, say defaulted bonds क्या होते हैं? The bonds, any company which has defaulted on the repayment or principal or interest payment of these. For example, INFS, right? INFS is there, they defaulted, right? But these bonds are still trading, right? So FPIs have been allowed to invest on those bonds, and if they are investing, they will not have to comply with the limits which are defined for them in the corporate sector. So FPI every year, RBI at the beginning of the year states that in particular year FPI can take how much exposure in the corporate bonds, in the GSECs, in India, in these markets. So if they are investing in the defaulted bonds, then those investment will not be counted in the limit that has been prescribed by RBI for the FPI investment for that particular year. So this will help more participation in the market. Right? In the area of payment systems, RBI has said that you all will be knowing that RBI had made NEFT 24/7, right? NEFT, please, again, if you don't know, please know the full form of NEFT and RTGS. NEFT was made 24/7 last year, last year, and RTGS was also made 24/7 in December 2020. Right, so now both the payments, the largest payment systems, both of them are which are under RBI, both of them are 24/7, and therefore RBI is saying now we will also have a 24/7 helpline with respect to any kind of queries or grievances related to digital payment products, right? So this they are going to do. Because if the service is available 24/7, the redressal and helpline should also be available 24/7. And second aspect in the payment segment is that they will enable participation in CTS clearing. So CTS has been there already from so many years. Still, RBI has mentioned that there are 18,000 bank branches in the country which are still outside the purview of CTS, and they are targeting to bring all of these 18,000 branches also under CTS clearing system by September 2021. Right? And on the last aspect related to consumer protection, RBI has said that they will come out with an integrated ombudsman scheme. As of now, there are 3 ombudsman schemes, one for the banking sector, the other for the NBFCs, and the third for the digital transactions. But there is so much overlap between these 3 and the transactions that are happening. Digital transactions happen through NBFCs also, banks also. So there should be an integrated approach, and therefore they will work to get an integrated ombudsman by June this year. So these were the key development and regulatory policies that RBI has announced in today's monetary policy, apart from, of course, the policy decision where they have kept the rates unchanged and an accommodative stance. Okay, taking up some MCQs today now. I have taken more of conceptual because I have discussed the fact-based things already today, and I have taken up some important conceptual topics that you should always keep in mind, which are inspired by the monetary policy. First, sale and purchase of GSECs, that is government securities, to and from the market for adjusting the rupee liquidity conditions in the market is known as what? Which of the following? Is it called the repo operations, open market operations, market stabilization scheme, reverse repo operations, or follow on offer? Yes, so these are called open market operations. So open market operations are conducted in GSEC. The purpose is to manage the liquidity in the economy. So when RBI wants to suck liquidity, that means reduce liquidity, then they will sell government securities. Why? Because the people will pay the money to buy those, right? And when the RBI wants to inject or increase the liquidity or money supply, then they will buy the government securities from the market. So this is one of the instruments for monetary policy for the RBI, which is very frequently used. Which of the following best describes the meaning of reverse repo rate? So we just discussed the repo rate, the reverse repo rate, all have remained at the same level, that has not been changed. But what is the meaning of reverse repo rate? It is the rate at which the banks earn on keeping excess money with the RBI, or is it the rate which RBI charges on lending money to the banks? The rate that the banks have to pay for availing excess loan from RBI beyond the LAF window, or the rate that the RBI pays to the banks on cash reserve which is maintained by the banks under CRR, or is it the rate at which the banks have to invest in the SLR securities. Okay, so for the first question, everybody of you were right. That is great. For the second question, the answer A is correct. Yes, Nilesh, you are right. Ashutosh, Garima Garg, all of you are right. So, there are two ways of describing the reverse repo. It is either the rate at which the RBI is borrowing money from the commercial banks. That is the more way of understanding, because reverse repo is the rate at which the banks are borrowing from the RBI. So reverse repo, we say, is the opposite, where the RBI is borrowing. But in effect, it's not like the RBI needs to borrow. It is the rate at which, if the commercial banks have excess money, they will keep it with the RBI, and RBI is ready to pay them interest on for that money, right? So there are two ways of describing this and looking at it at the same time. Question number 3. In today's monetary policy, RBI has included NBFCs also in the on-tap TLTRO scheme. Which of the following is not correct with regard to this scheme? Okay, so basically what is the TLTRO scheme is what I am asking here. And if you know that, then you will know which one of this is correct and which one of this is not correct, right? Under this scheme, banks can avail funds from RBI at a floating rate which is linked to the policy repo rate. Or is it the sectors that are eligible under this scheme also include the 26 stress sectors identified by the KV Kamath committee? The liquidity which has been availed by the banks under this scheme has to be deployed in the corporate bonds or the commercial paper or the non-convertible debentures which are issued by the entities in these sectors, and the exposure under the scheme are exempted from the large exposure framework. So, or none of the above. Which of these is not correct? So when you're writing the answers in the comment, it will be good if you can write the question number also, because sometimes there is a lag and I am unable to understand for which question you are answering. So the answer for 3 is actually E. All of these are correct in relation to TLTRO. If I have to summarize the scheme here, these are the points. As of now, the TLTRO is allowed for long term. The full form, it is targeted long term repo. Long term, why? Because these repo transactions are allowed up to 3 years. Targeted, why? Because there are only few or certain sectors to which you can lend under this scheme after availing money. So it is allowed up to 3 years. Total amount of 1 lakh crore. As of now, this amount can be increased by RBI later also, but as of now it is 1 lakh crore, and the amount can be availed by the banks from RBI at a rate which is linked to the policy rate. Okay, so it is cheap money for the banks to get. This scheme is available up to 31st March 2021 as of now, and RBI had initially, when the first time they had launched in October, they had identified 5 sectors to which the banks could lend this money after taking from RBI. Later in December, they had added the 26 stress sectors which were identified by the KV Kamath committee. Okay, so the 5 sectors were initially allowed by RBI were agriculture, infra, retail, secured retail, MSME, and healthcare, pharma and drugs related industry. Later, the 26 stress sectors were also added. I have not listed down all the 26, but some of the key ones that were identified by KV Kamath committee were auto sector, which included auto manufacturing, auto retail and all. Aviation was there, hotels was there, logistics, real estate, construction related, so building materials, cement, real estate, power, roads, sugar, textiles, trading, wholesale trading. So these were some of the sectors that were identified. As I said, I have not listed all 26. You don't need to remember all the 26 sectors also, but yes, do remember the name of the committee that identified these 26 sectors, which is the KV Kamath committee. Another important point to note in this KV Kamath committee was the 5 ratios that they had given that were used to identify the stress. Okay, so those 5 ratios also you need to know. There was a session that we held to discuss those 5 ratios and this stress and how the resolution has to be carried out. You can see the such that video in the description box. Further on, under the scheme, the money that has been taken by the banks, it has to be deployed in the form of corporate bonds, CP or NCD, basically any instrument, debt instrument issued by the entities, or any loan that they want to avail from the banks. And the investment that the banks are making under this can be classified as HTM, even if they are more than the permitted limit of 25%, and they are also exempt from the large exposure norms given by RBI. Along DX, this session is important for SEBI phase 2 from the point of view of yes, it is because the RBI monetary policy forms very much the part of for the general SEBI general phase 2, yes, and SEBI research phase 2. So for 2 categories specially, it is important session. Okay, next question. What is the limit that the bank is allowed to take on an individual exposure as per the large exposure norm? So we just stated that under the TLTRO, if you are lending to the entities in the stress sectors, they will not be counted towards large exposure norms. But what is the actually the large exposure norm for a bank on an individual exposure on a company? The answer to that is 20%. So on a individual or single counterparty, the exposure allowed is 20%, and a group of connected counterparties, the exposure is 25% of the eligible capital. The eligible capital is basically your tier 1 capital for a bank. The fifth question, we were discussing that the RBI policy is saying that all the banks will be brought under the CTS, that is the check truncation system in India by June 2021. They will complete, whoever are left, around 18,000 banking branches are left. So when was CTS introduced or became applicable in India? I think this is a very easy question if you will pay a little attention to your banking transactions. Yes, Nilesh, that is 4. Okay. So 4 you said C was correct. And the fifth, yes, fifth is also C. It is 2010. So it was in use in 2010. So if you will see a checkbook, if any of you or all of you must have a checkbook. If you don't have your own, your parents may have it. So at the check you will see here something is written, right? So this is written as CTS 2010. Okay, so all banks bank checkbooks have to have this written, only then they are a part of the CTS 2020 check truncation system. What it happens is, why is it necessary is then it can be read through the IMSCR's track. The check can be read electronically and you don't have to physically present the check, right? So to make it the payment system more efficient and quick, this was introduced in 2010. So if you have seen your checkbooks, you would know this is 2010. Next question. So we had suggested that RBI is going to bring an integrated ombudsman scheme. What do they call it? What have they suggested the name as, or how they have presented it in the MPC? What is RBI calling this integrated ombudsman scheme? One way is, yes, integrated ombudsman scheme. They have also given another name. What is that name? Okay. So they have given, in line with the other same trend which has been going on in the country by the government for various schemes like One Nation, One Ration Card, so on the same lines, the RBI has said that we will be adopting the One Nation, One Ombudsman approach for the grievance redressal also, and they are targeting to roll out this integrated ombudsman scheme by June 2021. Okay, so that's the last question from my end. One question I am asking, which you can again write in the comments box of this video. What is the name of the platform that is to be called to give access to the gilt market to retail investors? Okay, so what is we going to call the platform to give direct access to the gilt markets by RBI to the retail investors? Right, you can write your answers in the comments of this video. This is the expert faculty at ixamBee for the preparation of RBI Grade B. We will come out with another good news for all of you very soon in relation to preparation of your RBI Grade B this year 2021. We have launched the new course, as I have been telling, which will include your descriptive part also for ESI and FM with evaluation of 5 mock tests for FM, ESI and descriptive English. For details, you can contact ixamBee. The number is there visible on your screen, or visit the website also. Okay. Thanks everyone. If you have not subscribed or pressed the bell icon, please do. Tomorrow, as I said, we'll have one more session related to the RBI annual report this week, which has been the RBI week for discussing the important documents by the regulators and the government, which will be important for your exam preparation. Thanks everyone for joining in. Have a good evening. We'll see you tomorrow again at 4 p.m.